Hi folks, welcome to this video which reviews how to account for a bond investment that is long-term, but it's an investment in a bond, as I said earlier. So in this case, we're going to look at the problem and we're going to decide how we're going to handle it. So now it says at the beginning of 2017, January 1st, Phantom acquires $300,000 of Spider Products, Inc. 9% bonds at a price of $278,384. So we can tell right away the bond trades at a discount. How do we know? Because the cash proceeds that you gave up are less than the face value of the bond, right? We know the coupon rate is 9%. We know interest is payable annually every December 31st. The bonds mature on December 31st, 2019. So we have a 3-year bond, right? The investment is going to give Phantom a return of 12%. So the marketer yield is 12%. So again, we know it's a discount bond. Why? Because the coupon is less than the yield. Phantom applies IFRS. What that means to us, because we have a bond investment, is that we're going to use the effective interest method in order to calculate any interest income that Phantom is going to book on these Spider bonds. And they're going to account for the investment using the amortized cost model. Well, yeah, because don't forget, under the amortized cost model, we amortize part of that discount into the bond investment to bring it up to $300,000 at the end of 3 years. So we want you to do an amortization schedule, make the entry at the end of December to record interest received and any interest income. We want you to prepare entries again at December 31st, 2019 for interest received, interest income, at the maturity of the bond. So that's to discharge the bond. And then what we're going to do is we're going to make the assumption that instead of Phantom holding the bond till December 31st, 2019, they decided to sell it. Okay, and they got proceeds of $285,270. So we want you to make the journal entry to update the interest accounts, and again they want you to assume that the interest has already been received and the interest income is already booked. So all you have to do is book the sale of the bond. And then I added a piece. Let's say that Phantom has a March 31st year end. So now we're not going to assume we have a December 31st year end. We're going to assume we have a March 31st year end. So I want you to make some adjusting entries to accrue interest at March 31st, 2018, and then make the interest payment at December 31st, 2018. So let's begin. First of all, they gave you the amount of proceeds that you paid in order to get, you as Phantom paid in order to get the bond investment. I want to do something a little bit different with you. I want to make sure you can calculate that using your calculator. So in the solution, I want you to use your calculator to verify the carrying value of the bond at the purchase date. So if you set P/Y equal to 1, why? Because payments per year is 1 payment per year. That's your interest, right? It's annual. You know your future value, or what you as the investor are going to get back, is $300,000. You know your PMT, or your payment that you're going to get every December 31st, is $27,000. How do I know that? The face value times the coupon rate of 9%, right? I also know my I/Y is 12. They tell me that in the question. I know the bond is a 3-year bond. And again, I can compute PV, and I will get $278,384. So now, the question also asked me, okay, to do an amortization schedule, and I'm rounding to the nearest dollar, okay? So in our case, if we did that, we'd start off at the issue date, carrying value of $278,384. Now here we are at the end of the year 2017. Don't forget, interest is paid every December 31st. So the investor, Phantom, would receive $27,000. But how much interest income would they book? Not that cash isn't the amount of interest income. Don't forget, under the amortized cost model, what would we do? We take the carrying value times the yield. So the carrying value times the yield is going to tell us how much interest income we have. And the difference between the interest income we book and the cash we receive is going to be the amount of the bond discount amortized. So don't forget, we got to get our bond from $278,384, which is what we paid as the investor, right? We're going to get $300,000 back. So we got to bring that bond carrying value to $300,000 at the date it matures. so that the bond can be discharged. So we're going to add that 6406 to the carrying value to bring it closer to that 300,000, and that's going to give us 284,790. Now don't forget, because my carrying value is growing to 300,000, if I multiply that by 12% to get my interest income for the 1-year period ended December 31st, 2018, I'm going to get a bigger number, which is 34,175. So again, if I took 284,790 and multiplied that by 12%, okay, I'm going to get 34,175, right? So the difference between the cash received and the interest income booked is going to be the amount of discount I amortize. Add that to the carrying value and you're going to get 291,965. Now, if I took my 291,965, I'm just doing that little calculation here, showing you, and multiplied that by 12%, I would get $35,035. And again, I'm adjusting it a little bit due to rounding. So the difference between the cash received and the interest income I'm going to book is $8,035, such that when I add that to my carrying value, my bond is now sitting at the maturity date at $300,000, which is what it should be sitting at, because that's the value at which the bond is going to be discharged. All right? So now, what are we going to do? The question asks us, now that we've done our little table, they're going to ask you to read some stuff from the table. They want you to make the journal entry at December 31st, 2018. Well, don't forget, every December 31st is an interest payment date. So you're taking in your cash that you're receiving as phantom. You're going to debit your bond investment by the amount you're increasing the investment by, right? Which is $71.75, and therefore you're going to credit your interest income here by $34,175. Similarly, at December 31st, 2019, all right, going to do a similar thing. We're going to update our interest accounts because we have to book that interest income. So Phantom is going to take in cash because Spider is going to pay them $27,000 in cash. We're going to increase our bond by the amount of discount we're amortizing, which is $8,035, and credit our interest income for what we've got in the table, $35,035. But don't forget, that's the maturity date. So what are we going to do? Now we're going to discharge the bond, meaning what? Now Spider's going to pay us $300,000, and we're going to credit the bond investment because now the bond is gone. We said to Spider, "Hey, bond, our investment's up. Give us our money," and they give you $300,000, right? So now those are our entries for Part B and Part C. In Part D, okay, they wanted you to assume now in this part that you sold the bond at December 31st. 2018. So if you go back to the problem, they said here, prepare the entry for the disposal of the investment if Phantom sold it on December 31st, 2018 for $285,270 instead of holding it to maturity. Now they asked you to assume that the 2018 interest has already been booked up to and including December 31st, 2018. So you don't have to worry about that, right? So what you need to do is you need to record whether or not you got a gain or a loss in the sale of the bond. So what you want to do is you want to compare the carrying value of the bond at the date you sold it to the amount of money you got for it. You only got $285,270 for a bond that was booked on your books at $291,965. So you're going to plug that amount on the debit side for $6,695. So if you got $285,270 for an investment that you have valued on your books at $291,965, you lost $66,95 on that investment. All right. Now, the part that I added is different. It says here now, if we go back to the question, it says now assume that Phantom had a March 31st year end. I want you to make the required, and so we're not assuming that it was sold on December 31st. Forget about that. Now I want you to make an adjusting entry on March the 31st and then the required December 31st, 2018 entry, and that would be to record your interest, right? So now, what would we do? Well, first of all, the last time we got paid interest was December 31st, 2017. Here we are at March 31st, which is our year end. So we want to book the amount of interest that's receivable from Spider. So how much interest are we waiting to receive in December as a result of hanging in the game for January, February, and March 2018? Well, we're waiting to receive $27,000. Don't forget, we get that from our little table here, right? That's the cash payment we'll get on December 31st, but we're accruing 3 months of it before that date. Why? Because our year ends March 31st, 2018. So what we're going to do is we're going to debit the interest receivable for 3 months, and we're going to debit the bond investment for how much? Well, don't forget, over the year, so we're going to go to the period within which your year end falls. Your year end falls in the 1 year that ends this date. So you've got a bond discount of $71.75 for the 1 year period ending December 31st, 2018. But I want to know how much would I have amortized up to the end of March 2018. So I want to take 3/12 of that, and that's going to give me $17.94. Now, some students would say, well, I'm confident with the debits I got, so I can just plug for my credit. Sure you can, but you can also calculate it. How? Well, don't forget, you also have to book interest income for the 3 months, January, February, March 2018. Well, you know for the 1 year ended 2018, you'd be booking interest income of how much? $34,175. So for 3 months, January, February, March of 2018, you'd book $85.44. So now that you've got the adjusting entry done, how is that going to impact the look of your entry at December 31st, 2018? Well, what happens? Don't forget, regardless of when your year end is, December 31st, based on the bond contract, that's still going to be the date you get your interest payment. So when you get your $27,000 in interest, you're no longer waiting to receive $67.50 because that's the receivable you had booked at March the 31st, but that's a part of that $27,000, right? Don't forget, you took 3/12 of that $27,000 and accrued it in here. Well, all I'm doing is saying if I'm getting my $27,000, which this is part of, then I'm no longer waiting to receive interest. So I can credit the interest receivable and debit cash. Well, guess what? What about the amount by which my bond investment went up? Well, your bond investment would go up by how much? $53.81. How do we know that? Well, don't forget, we would have expected the bond investment to go up by how much? For a whole year, $71.75, right? That's the amount by which the bond investment would increase. But it already increased $17.94 of that, so it would be increasing by the difference, right? So that's the amount it would have increased for a whole 12 months, but you've already booked $17.94 of it from January to March, your year end. So the balance would be $71.75 minus $17.94, what you already booked, or what you can do is you can say, well, I'll take the whole 12 months and just allocate 9/12. That's for April, May, June, all the way up to December 31st, right? Now don't forget, I also have to book some interest income. Well, don't forget, for the whole 12 months, you would have booked interest income of $34,715. That's from your table. You've already booked 3 months of it, so you can now book the other 9 months, or say, well, if I would have booked $34,175 for 12 months, I've already booked $85.44 for 3 months, so that's what would be left for 9 months. Or you can take the whole 1 year and take 9/12 of it. Because don't forget, you took $34,715 for 3 months. The other 9 months has got to go from September to December. So that would be the journal entry to receive your interest payment, adjust all the interest accounts, and adjust your bond investment account. So hopefully you found this little review on the amortized cost concept a little bit of a help. And some of you might notice it's a little familiar because we did something similar when we took our liability course with bonds payable, only in this case, you're looking at it from the investor side. With the bonds payable in your prerequisite course, you were looking at it from the issuer side. So hopefully you find some connections in there. So anyway, you guys have a good day and hope you found the video helpful.